You know, so many families feel like they're on a financial treadmill, just working so hard to stay in the same place. We worry about things like student debt, market crashes, and whether we can really, truly give our kids a better start. But what if? What if there was a way to write a completely different financial story for them? Well, let's explore how one family did exactly that. Just think about that for a second. We're not talking about a simple savings account here. I mean a flexible, resilient financial tool that grows with them, protects them when things get uncertain, and actually empowers their biggest dreams. A tool that could help close that legacy wealth gap, but for your own family.
So, this is Sarah and Mark, and like a lot of new parents, their whole world has just been transformed by their amazing new daughter, Maya. And right away, they're determined to build a foundation for her that goes way beyond the basics. They want to set a strategy in motion that's going to give her a lifetime of choices.
Okay, so their journey starts right after Maya is born. It begins with a single, really powerful decision, one that's designed to compound for decades to come. Sarah and Mark chose something called an Indexed Universal Life Policy, or an IUL for short. The best way to think about it is kind of like a financial hybrid. On one hand, it's got the protection of life insurance, but it also has this engine for growth, a cash value account that's linked to a market index. And the best part? It can grow tax-deferred, meaning they're not paying taxes on that growth year after year. So how does this thing actually work? Well, first off, the premiums are flexible, which, let's be honest, is a huge plus for a young family. Second, that cash value gets to participate in the market's good years, and all that growth is tax-deferred. That's a massive advantage. But third, and this is really the secret sauce, by starting when Maya is just a baby, they're giving her policy the most powerful force in all of finance, decades and decades of uninterrupted compounding time. And it turns out, Sarah and Mark aren't alone in this, not by a long shot. The market for this kind of juvenile life insurance is projected to grow at over 13% annually. So this isn't some niche idea anymore. It's becoming a major trend for parents who are looking for more powerful, more flexible tools for long-term legacy planning. All right, let's hit the fast forward button and see how this seed they planted really starts to grow. We're going to jump ahead 18 years to a huge milestone in any young person's life. And for many, a huge source of debt, college. So for 18 years, this policy has just been quietly humming along in the background, growing steadily. Now, Maya's gotten into her dream school, and her parents are ready to put that long-term plan into action. Okay, this is where things get really interesting. Look at the contrast here. While a lot of her friends are busy filling out student loan applications that are going to follow them for years, Maya has a completely different path. She can take a loan against her policy's cash value, and because it's a loan, it's typically tax-free. Plus, unlike something like a 529 plan, that money isn't just restricted to tuition. And this right here hits the nail on the head. It's all about flexibility. If Maya needs money for, say, an unpaid internship in another city, or to study abroad for a semester, or even just a new laptop for her classes, the funds are available, no penalties. It's about funding her entire education, not just the tuition bill. Okay, let's jump ahead in time again. Maya has graduated, she's building her career, but as we all know, life and the market is rarely a straight line pointing up. So picture this. Maya is 30 years old, and bam, the economy hits a massive downturn. Retirement accounts are plummeting, people are panicking, financial anxiety is absolutely everywhere. This is the kind of event that can set an entire generation back financially for years. But look at this. Just look at this chart. While the S&P 500, which is tied to so many investment accounts, drops by a staggering 30%, the cash value in Maya's IUL policy loses nothing. It hits a floor of 0%. How is that even possible? Well, it's because of a core feature in many of these IUL policies called the 0% floor. Here's what's so critical about that. Her cash value gets to ride the wave up during the market's good years, but when the market has a bad year and goes down, her principal is protected from those losses. She never has to dig her way out of a 30% hole. And that's the promise right there. It's the promise of downside protection. This isn't about avoiding risk altogether. It's about building a foundation of certainty. For Maya, this means her financial base is secure, even when the rest of the world feels anything but. And you know, that kind of stability and peace of mind is what allows Maya to move forward with real confidence. Which brings us to the final and I think most empowering phase of her entire financial journey.
Let's talk about this advanced concept, often called infinite banking. Because Maya has built up such a substantial, liquid cash value in her policy, she can now essentially become her own source of financing. Instead of going to a bank and paying them interest, she can take a loan from her policy. And in a sense, she pays the interest back to her own policy, letting her money keep working for her. And this just opens up a whole world of possibilities. She can use the funds for a down payment on her first home. She can grab some seed money to finally launch that business she's been dreaming about. It becomes this private, flexible source of capital. And all the while, the policy can still be growing. And one day, it will provide a death benefit, allowing her to leave a legacy for her own family.
So let's bring this all together. Let's look at the incredible lifelong impact of that one single decision her parents made all those decades ago.
You know, Maya's story is just such a powerful testament to the magic of long-term thinking. What started as just small, consistent premium payments for a newborn's policy blossomed into a lifetime of financial freedom, real security, and, most importantly, options. Her journey really shows us the three pillars of this strategy in action. First, you've got the incredible power of tax-advantaged growth over a long period of time. Then there's the peace of mind that comes from downside protection. And finally, the unbelievable freedom that comes with having flexible, accessible capital. It's not just a product, it's a plan for empowerment.
And that really brings us to the final question, the one for you. Maya's story is just one example of how a different financial path can be created. It really challenges all of us to think beyond just next year, or even the next decade, and to ask ourselves, what legacy of options do we want to create?